Good evening, everyone. We're glad you could join us for today's session on international taxation. Let me begin by introducing our speaker for today, Parul Vivek. With over 20 years of expertise in the technology and telecom sector, Parul is a seasoned professional in global trade and tax compliance. Her work has shaped many multinational companies navigate the complex world of cross border regulations, import export frameworks, and international taxation. Armed with a strong academic foundation in economics, finance, and law, Parul brings not just technical mastery, but also strategic clarity to the table, ensuring that global operations run both smoothly and compliantly. In a world where borders are constantly shifting and regulations are ever evolving, Parul stands as a trusted guide, bridging policy and practice, strategy and compliance. Please join me in welcoming Parul Vivek. Before we start today's session, I request that our learners post their questions in the Q&A tab. We will try to address as many as possible if the time permits. At the end of the session, we will display 3 polls on your screens and request that you actively participate in these polls to help us understand your grasp of what was covered in this webinar. Correct answers will also be displayed once the polls have been answered. With that in mind, here's a very warm welcome to you, Parul. We're glad to have you present at the Industry Interaction webinar. Over to you for the main session.
Hey, thanks, Meghna, and hi, welcome everybody. I'm really delighted to be here to talk with everybody about cross-border or international taxation, a topic that is close to my heart. It is as thrilling as it is massive and complex. To be honest, it's like a vast ocean. It spans legal frameworks, economic theories, global policies, practices, politics, everything, and including corporate strategies. Covering everything in just like a single session of 1 hour would not be doing justice to this topic. It would be like trying to summarize a world tweet in world, entire history of world in one single tweet. So my goal today isn't to give you an exhaustive deep dive. I'm myself a learner. Instead, I will offer to share a structured framework to be able to understand the key concepts and highlight a few areas that are especially important and may be interesting for you to explore further. Think of this like a beginning of a longer journey. International taxation is a field worth understanding if you're really curious about global business, economics, or policy. And I hope that today gives you a good or a useful map to start with. You are able to connect the dots: who gets to tax, what, where, and why. With that in mind, shifting to the agenda, uh, we are going to cover cross-border taxation, the principles, key terms, constitutional aspects, emerging trends. But before we get into all of these topics, I would like to ask some questions or maybe give you some questions so that you start thinking, why is this topic important? So, do you know where most of the world-class tennis players live and why? Formula One drivers, they race anywhere and everywhere across the world. But when it comes to a living, they also choose one same pit stop. Is this a coincidence? Is it the weather, the sea view, the lifestyle, or something else? And every day we read newspapers or we see some countries attract a lot of tourists. There are influx of tourists in many countries, but many other countries attract corporate headquarters. Why? We also see that worldwide MNCs have factories in China, Vietnam, Thailand, global customers. They have R&D in India. But where are the corporate headquarters? So all of these have something in common. A US-based video streaming company today has, let's say, no offices in India, no employees, no servers in India, but millions of users in India, big user base, and who pay like monthly subscription for the streaming service. Does this streaming company need to pay any taxes in India? So all of these are questions that are not easy to answer, may not have one answer, but you have to look at it in totality. And with what we are going to try and cover today, you may be able to figure out, at least the curious mind will start leading to some questions. Oh, this may be because of this, and you will try and connect the dots. So moving on to next slide. What really is then cross-border taxation or international taxation? Somebody has said it is like a study of coordinating the tax authority of so many other sovereign countries. Basically, international taxation is nothing but it is like a framework which is applicable to cross-border activities of individuals and corporations. As global trade continues to move away from the standard brick and mortar physical office locations, more to digital commerce, digital trade, commerce, e-commerce, this topic gains even more relevance. And MNCs today operate in a very, very complex network or landscape of different tax jurisdictions. Now, when did this international taxation start? Is it something new? Not really, because the trade is as old as, centuries old. So the origins of international taxation really can be traced back to the earlier 20th century when the League of Nations was set up for the first time and it proposed methods for international tax policy. It was somewhere around after World War One. And the entire aim was to avoid double taxation, ensure fair distribution of taxes among different countries, basically the tax revenue, so that there is not a bigger share going to one country. And since then, this legal framework surrounding international taxation has significantly evolved, particularly through the OECD and the UN conventions or the frameworks. And the objective of international taxation could be varied, but everything works towards creating a balanced system for taxing global trade, avoiding, as we said, double taxation, preventing tax evasion, ensuring fairness in taxation, and facilitating cross-border economic activity. I think economic activity is the most. Wherever trade goes, the taxes or whatever more and more legal frameworks evolves around that. All businesses, whether through MNCs or whatever, they need confidence that their profits will not be subject to excessive or some kind of an unfair taxation. Now, what is why do sovereigns or why do nations tax? See, right to tax is basically a core element of national sovereignty. It is needed to fund government operations and provide public services. So, this international taxation then addresses two key issues. How does domestic tax law applies to non-residents who are earning income in the country? And how, secondly, countries tax the income or the global income of their residents? And honestly speaking, there is no one big document that we can read, and which is called international tax law. It is really a patchwork of countries' unilateral tax measures, which are enacted via domestic laws, coupled with a lot of international treaties. It is a constantly moving puzzle. It is dynamic. Each country has its own rule book or a playbook of taxes. And now you can add hundreds of other bilateral agreements or treaties that the country has entered into with different countries, depending on who's doing business with whom. And all of these modify or override this particular rule book that the country has. In the box on the slide, you can see some of the funny quotes that people have talked about taxes. It could be about domestic taxes or even international taxes. But yes, this field is worth exploring and is not something that is easily understood. So moving on then to next slide. Uh, Given that there is no one rule book, there is nothing in one document that can be read, there still should be some kind of foundational or guiding principles that help us to navigate this maze. How do we figure out what to tax, whom to tax, and where to tax? So there are some guiding principles which are based on the source or the residence or a kind of a hybrid approach. The distinction between source and residence-based taxation is really fundamental to understanding how countries exercise their taxing rights. Source-based taxation is something that allows a country to tax all the income that is generated within the borders of the country, regardless of wherever that taxpayer's residence is. I'm assuming here that most of us are familiar with the concept of residence, who is a resident, who is a non-resident in terms of an individual or corporation. Using that as a base, we are discussing about source or residence-based jurisdiction. So what is then residence-based taxation? That is something that allows a country to tax the global income of its resident. I may be a resident in India, but earning income elsewhere. So my country where I'm a resident, that has the right to tax the income that I earn anywhere else, including where I stay. In reality, most countries adopt a kind of a hybrid approach, taxing both the residents on their worldwide income and non-residents on their income, which is earned within the country or generated within the country. Now let's step back and see why some of these, principles are justified. Why is source-based taxation justified? Have you ever thought why? Why should a non-resident income be taxed in a country where the income is generated? Simple answer is because economic activities such as selling of goods, provision of services, using of local resources happens within the source country. The country provides the infrastructure, the legal systems, labor, and market access that enables this generation of income. Hence, it's really reasonable that they earn a share of the resulting profits. So, tax should be basically paid where the economic value is added. Let's say, take an example, a non-resident company, which is located, let's say, outside of India, conducts its business through a branch or factory or local office in India. So India could apply the source principle to tax the profits attributable to this particular branch or factory or office. Another example could be royalties, dividends, interest income. Those may be subject to withholding tax in the countries where these payments originate. We have heard the concept of TDS, so something like that. If a resident individual receives dividends or from a corporation in another country, so that country may tax such dividends at the point of distribution or origination, even though that resident or individual lives elsewhere. Another example could be really rental income, income from immovable assets like real estate. Where is it taxable? It's really taxable in the country where the real estate is physically located. So that's what we just covered about source-based jurisdiction. Why is it justified? Now let's also look at why would a residence-based taxation justified? It is so because the taxpayer resides in the country, uses its resources, and is protected by the law of the country. It establishes kind of a fiscal connection. The resident benefits from the social, legal, and economic infrastructure. So again, it's fair that they contribute to the public revenue. So the basic premise is if you earn here, live here, or are based here, you pay taxes here, even on the income that is earned elsewhere. Moving on to the next slide then. Again, continuation of the principles. Now, we would have heard about, this is a little bit of a segue into a different types of principles as to what governs taxation. Most of us have heard about canons of taxation by Adam Smith, that taxation should promote equality, convenience, certainty, economy. Now, take those principles and apply in an international context. Then we get those principles of tax neutrality, tax harmonization, tax fair play. What is really tax neutrality? It basically says that the taxes should not define people's decisions. They should not distort economic decisions of people. What is my decision today when I'm spending my income or buying thing? Where do I consume? Where do I save? Where do I invest? That those are individual decisions. Then look at some of the decisions of a corporation. Those could be where should the companies locate? Where should they produce? Or where should they invest? So any kind of taxes in a perfect world should not kind of uh, distort these decisions. Now, add to this neutrality, there are concepts of capital export neutrality or capital import neutrality. Capital is the money or the investment. So the main underlying principle for capital export neutrality says that a resident should pay the same taxes, total tax, whether they are investing in India or their resident country or elsewhere. And for capital import neutrality, a principle which says that all investors investing in a particular country should suffer the same tax risk, irrespective of wherever they come from. So that is, the tax neutrality aspect of uh, really a canon of taxation in an international tax context. Now imagine a situation where there is an again international tax player who's a resident of, let's say, Spain. They can earn prize money anywhere, US, Europe, anywhere. They may earn some endorsement income in Japan. They could earn some appearance fee in Dubai. How and who can tax this income, his or her income? These are the questions that international tax helps taxation helps to answer. It's not only restricted to corporation, it's also you can also juxtapose it in a context of individuals. Now let's look at tax harmonization. What does it really means? Harmonization means basically in very simple terms standardization. Can there be a process of adjusting tax systems of different jurisdictions in the pursuit of a common policy objective? Can different countries not have different provisions of taxing the same income? This will help to avoid disparities that can lead to unfair taxation or tax avoidance. This concept basically kind of encompasses the standardization of tax base, the tax rates, and overall rules for international transactions. So that goes the second principle here from a canon's perspective. And another principle is tax fair play. Fair play, we all know, would mean equity, equitable. Basically, we're saying the tax system should be such that it should be everybody should play by the rules, and it should not be bent so far so that the system is breached for everyone else. It should not give unfair advantage to certain group of taxpayers. It's more like a ethical and a policy concept. People, let's say, who use a toll road should be the one who should pay the toll. People who park their vehicles should be the one that who pay the parking fee. Something else should not come and subsidize people uh, who are using the toll roads and hence they do not pay. I mean, I'm just simplifying this a little more, but that's the basic concept. Okay, now pivoting to some of the key terms, which is a very, very interesting topic, because all of these terms that we have discussed, some of the terms I've already touched upon, but we'll do a deeper dive into each of them and see what do they mean. So what is really double taxation? We've all heard so much about double taxation. In simple terms, it means taxing the same income twice, right? So logically, each income should suffer tax at least once, but not twice. So there should not be something, the income should not escape taxes, but it should not suffer double taxation. And how does double taxation happen in an international scenario? It happens basically when two countries impose the tax on the same income or asset. For example, a company may be taxed in its country of residence and also in the country where it generates its income, leading to a higher overall tax burden. Moving on to what is really a double taxation avoidance agreement or a treaty. See, it's simple terms again, it's a bilateral agreement, traditionally a bilateral agreement between two countries that aim to eliminate or mitigate such kind of a double taxation of income. These agreements kind of establish the taxing rights of each country with respect to different types of income, which could be business profits, royalties, interest income, dividends, capital gains. And we talked about a little bit briefly about the OECD model and UN model. So there are these OECD standard model of framework and UN model, which serve as a primary framework for governing these tax treaties. If you just do a Google and see what are the key elements that should be included in a tax treaty basis a OECD model or a UN model, you will be able to figure out what are some of the standard terms. Now, why is double taxation really discussed so much in the context of different countries? Because it can really have a crippling effect on international trade. It reduces the profitability of cross-border transactions, making them uncertain. Businesses, as we said, want certainty when they're conducting any operations in a particular country, whether the same country or abroad. And double taxation agreements can also give some kind of a bilateral relief, unilateral relief. There could be some friendships between different countries by way of which multilateral reliefs could be given or granted. And we'll touch on some of this a little later. Once we cover some of the key terms, we'll do a little bit of case studies also as to how this entire field is evolving. Now, moving on to transfer pricing, which is also a very important concept. What is transfer pricing? We all would have heard it, and there are so many news articles that come every day on this topic. It is basically a method by which prices are set for transactions between associated enterprises. If I'm in India and I have another branch or subsidiary elsewhere in the world, how will we pay for that for different transactions, whether it is exchange of money or exchange of, like what I said, the business profits, royalties, cost, whatever the investment. If I'm making an investment elsewhere, how do I earn a rate of return? What is justified? So these transactions again can cover sale of goods, provision of services, use of intellectual property, or lending of money or investing of money. And why this is important? Because this helps to ensure that intra-group transactions, the transaction between my company in India and my company elsewhere in the world, is conducted at an arm's length, like a third party, like how two third parties would interact, meaning the prices reflect what independent companies would charge for similar transactions in similar circumstances. There are 5 or 6 methods for transfer pricing, like resale price, transactional net margin method, controllable, comparable, uncontrolled price method. And those are good prices, good methodologies to learn and review on your own when you have free time, because it gives you a understanding of what method of transfer pricing may work in a particular scenario. And now we are also talking about a lot of advanced pricing agreements where the companies are entering with the countries into advanced pricing agreements, so that the transactions are already covered and there is no uncertainty into what value or what monies will be exchanged for different type of transactions. Okay, so we've done the treaties and we've done transfer pricing. We've talked about double taxation. Now, we've also heard a term treaty shopping, tax havens, all of those in this international taxation topic. All of us would have read at some point in time or would be reading. So, what is really treaty shopping? Treaty shopping means resident of a third country taking advantage of a fiscal treaty between two contracting states. It involves use of two tax treaties between two countries to reduce or eliminate taxes that would otherwise apply. So what happens really in this? An individual entity routes its investment through a third country or an intermediate country which has a favorable tax treaty to take advantage of the lower tax rate or tax exemption for similar transactions in the intermediate country. I know this might sound a little heavy, but imagine if you can pivot to the next slide for a few minutes, Meghna. Yeah, if I can share with you this pictorial chart. Assume the investor is in country A, and they have a investor or a corporation in question. You can see they want to make some kind of investment or set up a subsidiary in country B, which is depicted by the black box. But there is no bilateral agreement between country A and country B. But country B has an agreement or a tax avoidance agreement with country C. So the investor in country A sets up really a intermediate company in country C, where the tax profits or whatever income will not be taxed, to take the benefit of the treaty between country B and C. That's basically a framework of a very simplistic framework of a DTA or double taxation avoidance agreement. If we can pivot to the slide before. Thank you. So now, now the question is, and I would want all of you to think, is tax management or tax planning bad? Is all tax planning bad? Tax evasion, maybe yes. Is all tax planning bad? Can companies, within the framework of law, plan so that they reduce their cost of operations, which includes taxes? So really, not all tax planning is bad. The legal right of a taxpayer to decrease the amount of what would be their taxes or altogether avoid them by means which the law permits cannot be doubted. Every tax planning is not bad. But tax planning is legitimate as long as it is within the framework of law, using of colorable devices, which means some sham companies, just purely a shell company, or when you look at substance over form, you figure out that is there really a meaning between an underlying transaction or the reason why the company is set up, and resorting to some kind of a dubious or incorrect methods, that is something which is not legally acceptable. Now, in this context, it's very important to look at some of the landmark judgments which have shaped India's tax landscape over the years. The main one, or what is talked about every time, is the Azadi Bachao Andolan. sometimes in the early about I don't remember the year, but it is basically about the use of India-Mauritius tax treaty, which was questioned to avoid payment of capital gains tax in India. There was a case that was brought up by an NGO which challenged that there are many entities which are being set up in Mauritius solely for the company for the purpose of taking advantage of the treaty between India and Mauritius. And these entities really do not have any economic substance or activity in Mauritius. In this case, the capital gains tax, which was arising from the sale of shares of Indian company, were exempt for tax from tax in India because the seller was a resident of Mauritius. So, there were few rounds of litigation and it was upheld that, the treaty was valid. The argument that it was misused for treaty shopping was rejected. But for sure, this case sparked a lot of debate about potential abuse of treaty and the need for anti-avoidance measure, which has helped to evolve the tax law or the international tax framework more and more over the years, not only in India, elsewhere also. And we've all heard about tax havens, which could be Mauritius, Cyprus, where the taxes are low, where the companies locate their headquarters, even Ireland, in case of some of the big companies like Google's, Apple's, Amazon's of the world, Luxembourg, which have been the places where the companies have set up intermediate companies or even their corporate headquarters to reduce the taxes. But the main point is that are they paying their fair share of taxes where they have set up? And this has sparked a lot of debate. The next slide, I've given some links to the articles. You could do a Google search. A lot of materials are available for you all to review and see how this entire field has been developing. If you can be at the previous slide only, Meghna. Yeah. So another topic which is often talked about in this context of international taxation is permanent establishment. And in short form, we always call it PE. What is really a PE? PE in very simple terms, again, refers to a fixed place of business, such as office, factory, or a construction site, through which a foreign company conducts its business activities or operations. If a foreign company has a PE in that country, in a particular country, then that country has the right to tax the profits attributable to this PE. And the recent developments, I mean, in all the digital economy and everything have really challenged this definition. Now, this definition is also evolving. There is a service P, there is a dependent agent P, construction P. A lot of different definitions have come and evolved. But now, we all know that the companies can engage in significant economic activities without really having a physical presence, like what we talked about. Streaming company, a video streaming company based out of the US, streaming everywhere, having a big user base outside of the US, but not having physical presence anywhere else. A very important case law, which is mentioned in this box, is also related to PE, which is about Formula One World Championship versus the Commissioner of Income Tax in India. Formula One, we are all aware. Sometime, I think in 2017 or yeah, one of those, yeah, around that time, Honorable Supreme Court laid down the foundation of what is really a PE in India or a permanent establishment. And let me give you a brief about the case. So, Formula One World Championship was a UK tax resident. It acquired commercial rights in F1 Championship held all across the world for some 100 years. In India, they entered into a race promotion agreement with JP Sports International, which kind of gave JP the right to host, stage, promote the F1 racing event in India. And for that, JP was supposed to make a payment to Formula One World Championship, which is a UK tax resident. Now, a lot of events were held in 2011 to 13. Then later on, there was a question that arose whether the amount received by Formula One World Championship was from JP in India, was taxable in India. And again, Honorable Supreme Court held that FOWC or Formula One World Championship constituted a PE in India by virtue of its control over the racing circuit. So you have to look at really substance over form. You have to look at who has the disposal of the assets in question. You have to look at the nature of business activity, the duration, the extent of control exercised by the non-resident to arrive at what constitutes a PE. I'll give you a few more examples of PE. let's say a temporary restaurant which is open somewhere, let's say in Netherlands or at a Dutch flower show for a period of 7 months. Uh, is it a PE? It was held to be a PE in there. Uh, Possession of just a mailing address in a state without an office, telephone, listing, or a bank account. Is it a PE? I don't think so. That's not a PE. But again, you have to look at the entire structure of the transaction, the intent of the transaction, duration, business activity, control, all of those things before making that determination. There are a few other case laws that we mentioned in the slide. Do look up and read because those are important ones which have kind of overall determined how tax law is evolving on the international tax front in India and elsewhere as well. Okay, we can move to the next slide. Again, here we've given those some of the news articles which are about Amazon's, Nike's, FedEx, Google's. I encourage that you make time to read some of these articles. Okay, we can now pivot to constitutional aspects. Why constitutional aspects are important? What is really the need to study or know these constitutional aspects in the context of international tax laws? You may ask, why do we really need to look at this? Okay. The main reason is because constitutional provisions really shape how international tax laws are really applied, whether they are valid, and what can limit the government power in the domain of this taxation. For legal practitioners, policymakers, or any businesses who are engaged in cross-border transactions with India, understanding these Indian constitutional provisions is really non-negotiable. It is essential. So let's look at some of the key constitutional provisions. Who can tax in India or why? What is the legal basis of taxation in India? That flows from the Article 265 of the Indian Constitution, which clearly says no tax shall be levied or collected except by the authority of law. It is flowing from the doctrine of constitutional supremacy. Are taxes legal? Then again, we have a federal structure in India. Who can tax international tax? Who can make laws on international tax? Who can participate in international tax conferences? It is the state government, central government. Who can enter into treaties and agreements with foreign countries and implementing those treaties, making changes in the domestic tax laws, agreements, or conventions? Who can do that? Basis those agreements or conventions. Again, this is enshrined in Article 246. You have the union list, state list, and there are certain items listed there which kind of detail out who has the power. Again, when I'm a taxpayer, I have a right. Again, those rights flow from the Constitution. Article 14 is the right to equality. I should not be discriminated against. No company should be discriminated against in terms of anything while you're a resident of the country. And especially, you can invoke this article even in case of taxation. And a company or individual can practice any profession, occupation, business, or trade in the country. That's also my right as a taxpayer. In recent times, there have been a lot of discussions about retrospective tax amendments. What can the government do? What can the parliament do, especially in the context of Vodafone International in the case that happened a few years ago? So the power to amend the constitution again is granted to the parliament through Constitution's Article 368, but it clearly says down that the amendments must not violate the basic structure of the Constitution. There are some limits on retrospective amendments to the law. And moving on to Article 51 and 253, again, how is India's commitment to international cooperation? We read that our ministers are leadership is going, India's leadership is going abroad, meeting so many foreign ministers, getting into entering in where the country is entering into different treaties. How does that happen? What is the underlying basis for that? Those are governed by 51C and 253. And once an international treaty is entered into, it does not automatically become a law in domestically. Then the parliament has to enact laws for the whole of the country or part of the country in to ensure that the treaty or agreement has been factored into basis whatever decisions were made into in the international conference. Nowadays, of course, there are many multilateral instruments in discussion. However, still the domestic law has to be amended to give effect to international agreements. Okay, again, an interesting definition as to what really is India and why do we need to know what is India? Why do we need to know the definition of India? We all say, oh, we are in India, an Indian company. I'm a resident of India. But why is it again important to know what is the definition of India? So we have to again, it's important because we have to understand the grasp of the legal reach of India's tax laws. The tax jurisdiction really depends on the territory of a country. It determines the geographic scope of India's taxing rights. What incomes can India legally claim tax on, especially when all these cross-border elements are involved. Today, we are all talking about data centers, seabed mining, uh, satellite transmissions, oil explorations, rigs everywhere, somewhere in the sea. Is that India? So again, it goes back to the constitution. What is territory of India? It includes the territories of the states or union territories and
Parul, give
any.
me
Yeah,
a second.
sure.
You can continue.
Thank you. Okay. So, what is really India? As we are seeing the definition here, it constitutes the territories of the state, the union territories, and any other territories that we acquire. It also includes the territorial water, the seabed, the subsoil, underlying such waters, the continental shelf, exclusive economic zone, and any other maritime zones, which could be in another act, which is like in the Maritime Zones Act, so on, and the airspace above our territory and territorial waters. So all of this has to be read together when we are looking at international taxation. And we also saw, India has entered into tax treaties with different countries. How does a taxpayer get relief under those treaties? Typically, tax relief is provided via two methods under the Income Tax Act, which is either a tax exemption or tax credit. Now, Income Tax Act Section 90 and 91, they derive their core from, I think, item 82 and 92C in the Constitution, which basically says that tax relief could be provided on double taxation, either by the exemption method, which is the exemption of incomes earned abroad from tax in the resident country. And tax credit is the country provides a credit to the extent taxes have already been paid abroad. So there are two sections, 90 and 91. 90 deals with those provisions involving taxpayers who have paid tax where in a country where India has a domestic tax arrangement or a treaty, a double taxation avoidance treaty. Now, Section 91 is really for those countries where India does not have a DTA, but the government could still give some kind of a relief. So this covers basically the entire framework of Indian Constitution, some of the key terms that we've looked at from international taxation perspective, some of the key principles like the source-based jurisdiction, the residence-based jurisdiction, the hybrid approach. Now pivoting to what's really happening uh, globally, what's now happening internationally. We are all hearing so much about crypto, uh, MLIs, new tax treaties, OECD models, but what's really happening overall and why really that is happening? So the government policymakers all across the world are now trying to work together on tax reforms that could significantly alter the way global businesses are taxed. If you're studying or advising on international tax laws, these areas are really critical for anticipating the compliance requirements, the tax planning strategies, and risk exposure for next few years. If you can move on to the next slide, Meghna. Yeah. So the key takeaway is really that international tax trends are leaning towards greater tax fairness. As you can see in the OECD BEPS pillar, which is base erosion profit shifting, as we all may know or may read about, OECD has come up with base erosion profit shifting two pillars. The pillar one kind of says we should reallocate tax rights to market jurisdictions, basically aligning the taxes with the value creation. Wherever the value is added, the tax is paid there. Then there is a OECD BEPS pillar two, which says that all countries should pay a global minimum tax, let's say 15%, 10% of subject to agreement. It's a so that there is like a fair taxation. Then there is no incentive for a company to allocate elsewhere, and no country loses the tax share. There is also a corresponding UN tax framework, which is more favoring developing countries, which is also trying to democratize the global tax rule making. Right now, it's not clear whether everything is going to move towards the OECD model or the UN model, but wherever a kind of an agreement will be reached, where the objective is again tax fairness, aligning tax with wherever the value is created. We've also heard about digital services taxes because everything is moving now to a digital trade kind of a model. There is transfer pricing, new models of methods of transfer pricing are coming for tax for making the determination between intra-group transactions. This will help to bridge the digital tax gap. And then this is CBCR. What is CBCR? It's like a country by country reporting. Why is this important? Because unless countries share information amongst themselves, there will be no transparency. Who has paid how much taxes? There is something called a public CBCR where some of the corporates are required to share publicly in maybe their filings, tax filings, or their annual reports, what taxes have they paid in different countries. And then there is also CBCR, which is country by country reporting, where the tax authorities of different countries collaborate to share information to make sure that there is transparency. We are also hearing now about carbon taxation, green taxation, crypto taxation. So all of this is something that is an emerging field in itself. So it's not something that can be learned in a day, but we have to keep our eyes on this. The major objective is targeting both profit reallocation, reduction of tax avoidance strategies. While all of this is happening, there are some new challenges that are emerging in terms of coordination between countries, the compliance, dispute resolution, because disputes always arise. It's not that you make a treaty and it will never be disputed. So there has to be a legal backing and mechanism to resolve disputes. As we wrap up today's session, I hope that you are able to understand that international taxation is not just about numbers and laws or mugging them. It's about understanding how the global economy functions, how nations interact, how businesses make strategic location decisions. Let's where should they locate, where should they invest to get the maximum returns. We are now kind of one step closer to understanding how the world works, if really we can understand how the tax system across the globe works. Thank you for your time and listening in. I'm open to questions or any other comments, inputs that the learners have. Make now.
One second, Parul. Thank you, Parul, for the very insightful session. I personally liked how you spoke about emerging trends. It was great to learn about global taxations. Dear learners, it's time to move to the polls. Remember, everyone who answers all questions correctly will receive a certificate that you can proudly share on various platforms. You're now requested to answer the polls on your screens and respond based on your comprehension of the session. Please note that to answer each question, you only have 1 minute. Since a lot of questions are pulling in, Parul, can we go to the Q&A session right now?
Sure, we can.
Right. The first question being, while working on global businesses, if the policy changes in the middle, how do businesses deal with that?
Yeah. Very good question. Not an easy answer. That's why I talked about the certainty of taxes or policies in the global context or even in a local context, a domestic context. It's always hard for businesses, and that's why businesses have to build in some risk scenarios that if this policy changes, because the global geopolitics is dynamic. We are seeing what's happening today on a daily basis. There is some new legislation, law, or you're talking about trade wars or tariffs that's coming up. So businesses have to be prepared to deal with any kind of an uncertainty. Sometimes, of course, everybody's caught unaware, but they have to build in resilience to be able to navigate some of the uncertain policy changes. And if and of course, policy when policy changes, there are obviously opportunities to go back and work with the governments to make sure that there is some room for giving some relief or rolling back those policy changes. However, that is a longer term. Businesses need to build resilience and factor in some of these risks and uh, uh, uncertainties in a global environment, especially. There's no clear one set of answer.
Moving on to the next question. How does taxation work in exchange of shares between two countries in a third country of investment?
Yeah. So again, this will depend on the principle that and the domestic tax laws that the two countries are following. Sale of shares, and we just talked about the India and Mauritius DTA and the Azadi Bachao Andolan case, where the sale of shares of a company which was set up in India, but the resident was in Mauritius, was held to be not taxed in India. So it all depends on what are the underlying tax laws in the two countries, the tax treaties that the countries have entered into. We cannot look at it in isolation. Again, no one answer.
Right. What are some of the most significant international taxation challenges facing multinational corporations in the APAC region, and how do we navigate these complexities?
Sure. Good question again. So APAC region is one of the most dynamic region if we talk about where the trade is flowing today, where the businesses are coming, whether you're talking about setting up of manufacturing or global capability centers, or even some of the manufacturing moving into countries like, let's say, Make in India, all of that. But however, the tax revenues okay, let me put it that way. The tax authorities and these countries are not so sophisticated. They're not able to use the digitization and all of those. Plus, because they are developing countries, there is always a motive to tax and increase the public size of public revenue. Hence, the policies are not evolved. So that creates challenges for businesses. You're talking about a country like a Vietnam, Indonesia. If you have to set up a full entity which does, let's say, buys goods and trading entity, it's not so easy because the laws are not clear in black and white, and you don't know how they will interact with, let's say, a company which is set up in US or Europe versus Indonesia or a Vietnam. So the tax laws in all of these countries are evolving, and there is a lot of room for further improvement. Hence, there is always a challenge in interpreting those laws. There are local language challenges. There are challenges in interpreting those laws and the application of those laws.
Great. Since all the polls have been answered, let's take a moment to see the answers. Okay, moving on to the next question. How do tax laws of different countries interact with each other, and what are the implications for multinational companies?
Okay. So each country is a sovereign country. They have the right to make their own tax laws within an overall framework of their constitution or the governing framework. So now, when I mean, we've recently reading in newspapers that India and UK entered into a free trade agreement, or there is a new bilateral agreement. India and US will also enter into a bilateral trade agreement. Within trade agreement, there will be some provisions of all of these taxes, and then there are other treaties. So the treaties are the ones that give effect to interaction of, the domestic tax laws. And in effect, treaties will require some changes in domestic tax laws so that the multinationals can, do business in a way which is, again, certain about the taxation and about overall policies.
Okay, moving on to the next question. Let's say I own a business in Mumbai and I want to open a branch in the USA. Whom do I pay tax? Both countries or only India since I'm based out of here?
Again, a branch office, what does a branch office do? How much of control is exercised here? You're a resident in India. Is the branch a permanent establishment that the US will also tax? Because US typically tax based on the source principle. India has a hybrid approach, taxing both the residents, domestic income, also the worldwide income. So again, the nature of transaction or of between the two entities, the transfer pricing arrangements have to be studied to be able to understand in depth what is the underlying transaction, who controls what is the business activity that is going on, and where should be the taxes paid. Of course, because the company is incorporated in India, the taxes have to be paid in India. Now the question arises whether any profits that will be earned from the US branch have to be taxed. If yes, who will tax it, whether it will be US or in India. And if US and India have a bilateral agreement, then the taxes paid in US could be, granted as a relief in India. So everything has to be studied from the point of view of end to end.
Okay, the next question being, when are companies called associated enterprises?
Okay, there are many definitions of associated enterprises in the tax laws. However, associated enterprises basically mean that there are relationships. Either there are controls, you have a say in making company decision, or you own part of it by itself or through other companies, through other subsidiaries, or managed or owned by the same parent company or the people who manage the other company. So, in a very simple terms, they're related. A business could have a say in making decisions. They could exercise some control either by shareholding or partnership, or they could be managed or owned by the same people. That's broadly an associated enterprise.
The next question being, some countries do not have income tax. What processes do they follow or what options do they offer their residents or businesses?
Yeah, I think many countries don't have because they may not have, okay, let me put it this way, they may not have any other way to attract. Why are these tax havens important? Tax havens are important. I'm just saying to attract domestic investment, right? So if there is no income tax, then maybe the tax revenues are not needed by the government. So there would be some processes enshrined in their domestic tax laws which allows them to not charge any taxes.
Moving on to the next question. Why did India decide to introduce transfer pricing?
Oh, transfer pricing, because if you have to be a part of the multinational overall framework, the transfer pricing guidelines have to be introduced as more and more corporates come and invest in the country. There has to be some guidelines on transfer pricing as to what is the method of charging or paying for different sale of goods, provision of services, use of IP, as I said, or even lending of money, loans to intragroup transactions. If that is not there, then let's say if a US company is investing $10 in India and there is a profit of $5, then the entire $5 could be extracted if there is no underlying principle or a basis of what should be paid for the intragroup transactions. So those rules are really essential in law to be able to transact global trade.
Okay, we have time for two more questions. Moving on to the next one. How can individuals or businesses stay updated on the ever evolving international tax landscape?
Very good question, and I think we covered it opening. It's you. There is no magical wand, or there is no book that can be read and you can understand
Learners, looks like we've lost Parul. That's all the time we have today. We hope most of your questions were answered. Before you leave, please provide us with feedback on this webinar by completing a survey as you exit this session. A recording of this webinar will also be made available on the LMS if you wish to view it again. Thank you once again, Parul, for this invaluable session. Our participants have learned something new today that is both informative and useful. And a
Sorry.
big thank you to all our learners. It's been great to see this level of participation. Thank you and have a good evening.
Thank you. Bye bye.